Welcome to another session of the financial accounting part of it of the course. We will do one more problem on cash flow statement to ensure that you understand the whole thing better before we move on to what is called as the financial analysis. So, when we talk about cash flow statement, as I have told in the past, there are two methods, direct and indirect method. The indirect method we derive from the balance sheet and the P&L statement and so on. I have taken a problem out here, that is what you can see on the screen out there. Let us, the problem what we have given is, we have given a P&L statement out there for the year and as well as the balance sheet for the current year as well as the prior year out there. And of course, some bit of additional information also given. I am not prepared, I am not given any question out there. I have just said prepare a cash flow statement. Let us do one thing, let us prepare both in the direct method as well as in the indirect method out there. That is what happens. So, as a last part of what you call it as financial accounting or this problem out there, we will help you understand better. That is, I will prepare, let us prepare the cash flow statement under both formats out there for the same problem. For the same problem, let us prepare it under both the formats out there, both direct and indirect, so that you will be able to comprehend how it is prepared both direct and indirect, and you will be able to comprehend the difference of them. So, given that, let us look at it. I am going to keep this as the problem statement out there, and I am going to move to the Excel, where I am going to look at preparing the cash flow statement for the year ended so and so under what is called as the direct method. When we say direct method, what do we mean specifically in this particular case out there? So, when we say this, what are we trying to look at? We said that we prepare both direct and indirect method for the same problem. Reason I am suggesting this is so that you will be able to comprehend it better. What is the difference between the direct and indirect? Now, let us look at preparing under the direct method. And when we prepare under the direct method, what are we looking at? We are starting with what is called as cash flow from operations out there in this particular case. Cash flow from operations out there. I am going to share my, I am going to use what is called as the screen in this way that you will be able to see both the problem on the left as well as my doing the working. I am just dividing the screen out. So, what are we looking at? As a first step, under the direct method, we say cash flow from operations. Cash flow from operations. Let us look at cash flow from operation. When you are looking at cash flow from operation, what is the key aspect out there? Key cash inflow is what is called as cash flow, cash inflow from what our customers or cash receipts, I would say, cash receipts from customers out there. When I say cash receipts from customers out there, I am just going to do some bit of working out here. Let us say I am going to do this. Well, what is the cash receipt from customer? We know that, in fact, if you look at cash flow or cash receipts from customer out there, let me term it as one cash receipts what are we looking at in this particular case? What is it? We have sales out there. What is the amount of sale, or what do you call it as, or I would say, or the revenue for the year, or revenue for the year 20x2 as far as from P&L out there. What is the revenue out there? If we see this in this particular case, the revenue from P&L is about 30,650. Now, what are we worried about? We are worried about cash inflow. Now, have you received all this cash out there? Have you received this cash out there? Well, I do not know. So, let me look at the debtors. In this particular case, I see that last year I had a debtors of about 1200 out here in this particular case what I have highlighted. So, what happens in addition to this 30,650 I need to receive what is called as add what is called as receivables from the year of the last year, that is all what there, that is 20x1 out there. What is the receivables of the last year? That is 1200 is the receivables of the last year. So, what is the total money that ideally you should have received out there? The total money that is totally you are eligible to receive, that is the money that you are eligible to receive from customer, the money that you are eligible to get received from the customers, eligible to receive is 31,850 or money you are eligible to receive is 31,850. But what is the due still in the current year out there? That is as far as debtors are concerned, there are 1700 dollars or rupees out there, that is you are yet to receive out there. This is I would say receivables. 20x2 out there, receivables of the current year is 17. So, what am I doing? You are eligible to receive 31,850, but out of that you are yet to receive 1700. That means what is the amount that I have ideally received? Ideally received is only 30,150, that is 31,850 is what I have to get from customers, because the sale for the current year is 30,650, last year's balance is 1200. So, I have to get 31,850. But I am yet to get 1700 as per the balance sheet of the current year. So, what is the money that I have received? That is what do you call it as cash received. Cash received is only what do you call it as 30,150, or what do you call it as receipt from customers is only 30,150 out there. So, what happens? Cash receipts from customers, let me code it as 1 out there, because that is what I am doing. Cash receipts from customers in this particular case out there is nothing but this is the amount of cash receipts from customers. So, similarly, let us go towards what is called as the what is called as the cash outflow due to cost of sale. Because here what we see here, let me give you the working and let me term it as number 2. The cost of sale as per the P&L statement is 26,000. Is this the money that has gone out? Now, let us see whether if this is the money that has basically gone out there. So, number 2 in this particular case I will do is basically what do you call it as cost of sale. Cost of not cost of sale, sorry, cash what do you call it, dispersed on for cost of sale. So, let us say what is the cost of sale, or CO, or what do you call it as inventory utilized. Inventory utilized as per the P&L is 26,000, perfectly all right. Now, in this particular case, what is happening? Whether have you have utilized this 26,000 inventory? Have you bought this entire inventory? Might have bought, might not have bought, because I might have had it in my stock out there. Let us go back to the assets in the balance sheet and let us look at the inventories out there. I see that my inventory is about 1950 at the end of last year, that is at the beginning of current year. So, what happens? I would have ideally not utilized this entire, bought this entire 26,000, because I might have utilized what is there from my what do you call it as from the inventory that I have. So, what happens? Reduce So, if I reduce my beginning inventory, that is 1950, that is what is the inventory that I would have ideally bought? The inventory that I would have ideally bought is 24,050 out there. The inventory I would have ideally bought is 24,150, that is ideally the inventory bought for utilization is 24,050 for utilization. But I see I have not bought only this $24,050 worth of inventory, because there is a closing inventory also, as you can see on the problem out there, 900. So, what happens? I have bought this 24,050 plus I have bought an additional $900 worth of inventory. So, what is happening? I am adding my closing inventory out there, that because that is something which I have bought out here, that is add a closing inventory out there, that means I have ideally bought so much out there. That means the total inventory bought is 24,950 out there. That means that is the inventory I have purchased. If that is the inventory I have purchased, then what is how much is the amount I have to pay? I have to pay 24,950 is what I have to pay. Am I with you on this? Let me repeat, that is, what is the cost of sale? The cost of sale is 26,000, or inventory utilization is 26,000. Have I bought the inventory that I have paid? Because only bought the inventory that I have utilized. If I have bought the inventory that I have utilized, then I have to pay for it. So, how much have I bought is what I want to know first. Have I bought this entire $26,000 worth of inventory? No, I have not, because there is some opening inventory at the beginning of the month of about 1950. So, I might have bought only 24,050 if I reduce that 1950. But I also see some inventory at the end of the month to the extent of 900. So, what is the inventory that I have bought? Inventory I have bought is, what is the cost of sale minus the opening inventory plus the closing inventory, and that is what we have got out here. So, ideally how much I have to pay? I have to pay 24,950. But have I paid that? I do not know. Let me look at the creditors. I see, I go back here and then I see my creditors last year was 1890. That means how much I have to pay? I have to pay, that is, add opening creditors out there. That means how much I have to pay? That is, I am liable to pay. I am liable to pay. Liable to pay. Liable to pay this, because I have to pay what is there in the beginning, due in the beginning. So, what is it liable to pay? 26,840. But I still see another 150 rupees still payable at the end of the year. So, how much have you actually paid? Payable at the end of the year. So, less payable here is 150. So, how much I have paid out there? I have paid only $26,690 is what I have paid. That is cash outflow. Cash outflow for the inventory. Cash outflow for inventory. Cash outflow inventory or cost of sale. Cash outflow. So, what has happened? Let me repeat this. We started with the cost of sale. From the P&L, the cost of sales is 26,000. Agreed. Have you bought this entire thing? Now, first thing, what did we determine? We determined how much inventory I have bought. So, how did you know that? How much inventory I have bought? What is utilized minus what is there in stock when I began the year, plus what is still left in the store. That tells me what is the inventory I have bought. Now, the next question, have I paid for entire thing I have bought? I not only have to pay for what I have bought, plus I have to pay for money that is pending for the beginning of the year. So, I have added that 1890. So, what is that you are liable to pay? You are liable to pay for what you bought plus the money that is due to be paid at the beginning of the year. So, that is the total amount that you have to pay, liable to pay. How much have you paid? The money that is yet to be paid at the end of the year minus that I subtract from the money that I am liable to pay. The money that I have to pay at the end of the year, I will subtract from the money that I am liable to pay. That is what I have basically paid. So, what happens? Cash outflow because of due to cost of sale in this particular case is this is the amount out there. So, in this particular case, what do? I always take it with a, what do you call it, as negative sign out there in this particular case, purely because of, what do you call it, as doing this is a cash outflow, that is a cash inflow. Inflow is plus, outflow is obviously negative out there in this particular case. That is why I took it with, what do you call it, as a negative out. Next, let us look at the P&L. Let us look at the P&L. P&L says admin, what do you call it? The admin selling expenditure to the extent of about 910 out there. So, there is nothing due or paid in advance with related to admin and what is called as selling expenses in the balance sheet. Neither if it is paid in advance, it will be in the asset side. If it is paid later, it will be on the liability side. So, what has happened? That means there is a cash outflow with related to admin and selling. So, cash outflow for admin and selling, how much is it? 910. That is there, I pick it up directly from here. Then what happens? There is what is called as, there is the depreciation, we see non-cash outflow. It is not a cash outflow, I will not take it into consideration, I am doing a direct method. Interest expenditure, not a cash outflow of because of operations, so I will ignore. Investment income, not an income because of operation, because of an investing activity, not considered. Dividend income, again investment activity that I made, because of that I am getting some money. So, cash inflow because of investment activity, I am not considering for operations. Then what else is this? Sir, there is an extraordinary item, insurance proceeds from disaster management out there. I have received some money, that is $140 is what I have received. Let me consider it. Normally this insurance proceeds, if you say, if the insurance proceeds what you have received is due to a disaster that has occurred in your plant, factory or the core, which is going to affect the core operating purpose, yes, this becomes a cash inflow because of operation. If this insurance proceeds is because of what is called as a compensation that you have received for some financial loss, that is nothing to do with, for an investment loss, that has nothing to do with your core operation, it will not come here, it will go in the investing cash inflow in the investing activity. So, in this particular case, I presume, let me repeat, I presume that this particular insurance proceeds, that is what I said, disaster management. So, presume that a disaster has occurred in your plant, factory, whatever it is, a fire or something has occurred and you have claimed insurance and you have received. So, cash inflow from operations out there. So, I will say cash inflow, insurance proceeds received is 140 direct, cash inflow. So, plus, if the same thing that said, insurance amount received for a financial trading loss that occurred, which also I have insured, then what happens? I will not consider that insurance proceeds here. Then what happens? There is something called taxes on income, $300. Normally, these taxes are considered as cash outflow because of your operation. Why? Because you are expected to make profit on the core operation. So, you are expected to pay tax on the profit that you have made from the core operation. Now, you can argue with me, sir, there is a dividend income, interest income, and on that you have paid, and that also that also would add to the profit and so on and so forth. Yes, I do not deny that. So, the tax which is pertaining to the dividend part or the tax which is pertaining to the investment income part, I will knock off. I will consider only the tax which is pertaining to the operations part and take it as a cash outflow here, but in this particular case that level of detail is not given, only some minor detail is given. So, what happens? I will consider in this particular case out there a cash outflow, in this particular case a cash outflow out there on tax as part of operations only, because normally as indicated these taxes pertain to the core activity. Profit pertains to core activity profit and tax on the profit pertains to core activity. So, let us look at income taxes, that is cash outflow for taxes. I am going to keep it as 3 out there and I am just going to do that particular calculation out here in this particular case out there. Taxes. Sir, why is what do you call it, I mean the further calculation required? No, because if you see the P&L, what is the taxes and income? $300. But I go to the balance sheet, it says income tax payable last year, income tax payable this year. So, let us look at what is the taxes as per P&L, tax as per P&L out there in this particular case is 300. The taxes add, I will say next add taxes payable, taxes still due or taxes payable as of 20x1, that means 20x1, that is about $1,000 out here. So, what is the total cash, total tax payable out there? The total tax payable is 1300 out there. Total tax payable is 1300 out there. So, let me say out of the total tax payable is 1300, but there is some amount still due at the end of the year. There is a $400 due that is yet to be paid out there. That is, so what is the amount that you have paid? The amount that I paid is total tax payable minus the amount yet to be paid. That is payables at the end of 20x2 out there is 400. So, total amount paid on tax is, what do you call it, as 900 out there. Total amount paid on pay, ideally, that is ideally tax that is paid is 900. Ideally the tax, why I say ideally, sir? Why? That is the amount of tax that is paid 900, agreed. But there is a small catch here. Go to the note out here. In the note, what I am highlighting out here, please note, tax deducted at source on dividend received included the expenses of 300 for the year amounted to 40. So, that means what? This $300 includes the tax that is deducted at source by the fellow who has given you dividend. So, how much as dividend? Dividends are 200. Tax deducted is 40, but deducted where? Deducted at source, not at your end. So, have you paid it? No, I have not paid it. So, what happens? What is the cash outflow then? The cash outflow is 900 minus that 40, that is less tax deducted at source. At source on dividend is about roughly $40 out there. So, how much of tax you have ideally paid? The tax that I have ideally paid, tax paid or cash outflow due to taxes is 860 out there. Tax cash outflow due to taxes is about 850 in this particular case out there, and that is exactly what we see out here. So, what happened? This $300 what you have said tax on P&L includes that 40, because that is what happened. It is a TDS, that is a tax which you have to pay, he has directly deducted. Whereas the tax liability is yours, you have to pay, but when I distribute it, I deduct some 20% of it and pay you the remaining. I will remit it directly on your name with the income tax authorities. On your name, I will remit that $40 with the income tax authorities. You are liable to pay, but I have already deducted. That is as per the rule, Government of India rule. So I will deduct it and I have already remitted. So what is the amount? Cash paid, cash outflow due to taxes. The cash outflow due to taxes in this particular case is, this is the amount out there. That is the money that you have paid. So in this particular case, it is 60. I have to have a negative figure out there. So what happens? It is minus out here. So it's cash outflow out there in this particular case. So what is the net cash flow from operations? That's all I see. Net cash flow from operations. Net cash flow from operations out there is nothing but a sum total of this, and I am just going to total this up out here in this particular case, and that is about 1830 is the net cash flow from operations out there. Next, we move to cash flow from investing activities. Next, we move to cash flow from investing activities out there. Next, I move to cash flow from investing activities. That is, I have invested money that is giving me return, whatever it is. Or I am investing money, cash outflow, cash inflow, whatever it is. Let us look at it. Now, when I say cash inflow, cash flow from investing activities, let me again go back to the P&L. I see that I have received two kinds of income, investment income and dividend income. So what is this? These two are a result of the income, that cash inflow that I have received because of the investments that I have made. Let us look at dividend income out there. Let us look at dividend income out there. When you see dividend income, it says $200 is the cash inflow. But note, how much is the cash that you have received? Because that fellow has deducted what? Deducted $40 from that. That is what we saw now. We just saw that out here. That fellow has deducted a TDS of $40. What is your total income accrued? The income accrued, no sir, my balance sheet says 200, my P&L says 200. 200 is the income that is accrued. On that income, $40 is the tax which is deducted, and that $40 deduction you have added to this 300. So what is the income? The net income that is received. 200 is the net cash flow that is received, 200 is the cash declared, $40 is the taxes. So net cash flow that you have received is only $160 out there on dividend. Net cash inflow that you have received is only to the extent of $160 as far as the dividend is concerned. So what is happening? Dividend income, we saw that $200. But what is the cash received? Cash received is only 160. So that is what I have written. Income is 200. Received, cash received is only 160. Sir, that $40 is a cash outflow. Yes, $40 is a cash flow. Not from you. It is outflow from him. Your money. But has it gone out of your pocket? No, at this stage. So we have not even taken that. Yes, in that case, the P&L had that $340 included out there. Next, we move to the next one, investment income. What is the investment income out there? In this particular case, the investment income in this case is $300. So what is the ideally, what is the cash that you should have received? $300. But let us go back to the P&L and see. In this particular case, investment, interest receivable at the end of the period, at the end of the current year is 100. At last year, it was 0. Last year, there was nothing due. this year 100 is still receivable. That means how much have you actually, what is the cash inflow that you would have received minus this 100 is the cash inflow that you would have received. Obviously, the cash received is only 200 because 300 is the interest income, investment income. Out of that 100 you are yet to receive. So, what is the cash received? 200 out there. That is all what we see out there. Next, we will look at what are the investments you make. Obviously, you will make investments in fixed assets out there. Obviously, you will make investments in fixed assets out there, fixed assets net out there. Investment you will make in fixed asset out there. That is investment fixed net fixed, investment in the fixed asset at cost out there. What is the fixed asset at cost last year? The fixed asset at cost last year is 1910. What is the fixed asset this year? 2180. That means what is the difference? Difference between 1910 and 2180. That is the amount of fixed asset that you would have ideally bought out there, 1910 minus 2180 out there. That is what it is. $270 worth of fixed asset is what you would have, let me do it the other way. 2180 is the current year, 1910 is the last year. That means what is the fixed asset out there? The total net fixed asset that you have bought. The net fixed asset that you have bought is to the extent of about $270 out there. The net fixed asset that you have bought is to the extent of about $270 out there in this particular case out there, $270. Is there a cash outflow of $270? Well, yes and no, because I do not see anything payable because of fixed asset purchase out there, any long term liability payable because of fixed asset purchase, I do not see anything out there. So, well, in a way, yes, that is the amount of cash that should have ideally gone out for purchasing a fixed asset out there. But let us see the adjustments out there. It says that during the period the enterprise acquired property, plant and equipment for about $350. Cash payment of $350 were made on the plant, purchase, property and equipment out there. That means during the period they acquired something for 350 and you have made cash. That means what is happening? Cash outflow, due to purchase of PPE, plant, property and equipment out there. That means that is about $350 has basically gone out there. You have purchased. But sir, you say the net purchase is 270. Let's wait. Let's see. Let's read the next statement. Plant with original cost of $80 and accumulated depreciation of 60 was sold for $20. Let us keep it first part only. Let us say plants with original cost of $80. What did we take here? In this particular case out there, we took at cost, original cost, gross value, original cost is what we took out here and said 270. So, plant with the original cost of $80 was sold. I have bought a new plant for $350. I have sold a old plant for 80. That means what is the net purchase that I made? 350 minus 80, that is exactly 270, and that is the number what we have got here. $350 worth of purchase you have made, $80 worth of plant you have sold. That means what is the net purchase? Net purchase is 270 and that is what we have got. But let us look at cash outflow due to sale of PPE. Oh, sorry, inflow. I am sorry. Thank you, Suhail. I think thanks to Suhail, I think Suhail has been my TA through this course. Mohammed Suhail works for his PhD with me, and then he has been the TA for this course, and is always keeps prompting me if I miss something. So, cash inflow due to sale of PPE. What is the, it says worth about $80 with accumulated depreciation of $60 sold for $20. That means what is the cash inflow? The cash inflow is only $20. The cash inflow is only $20 is what I have got. Sir, it is worth $80. You sold at $60 is depreciation. Depreciation is not a cash outflow. Sir, you have made a loss. I am not making a profit and loss statement. I am preparing what? Cash flow, what cash has come in, what cash has gone out. That is all what we are trying to do out here. So, in that we will see what is the cash flow from investing activity. Investing activities out there, that is nothing but sum total of this, that is, if I have to say, sum total of this, that is I would say this plus this plus this plus this out there, that is about $30 is the cash inflow from investing activities out there. The last part of it, what we see, cash flow from financing activity. From financing activity out there, let us see the financing activity part of it there. Again, I will go back here. We will start with the P&L. Interest expenditure rupees 400, $400. That means there is a cash outflow because of interest. Cash outflow due to what do you call it as interest payment. I am going to ideally put it as 4, perfectly all right. Now, in this particular case, I am going to say in this particular case out there, interest payments. What is the amount of interest expenditure? Interest expenditure is 400, that is interest expenditure is about $400 out there. Whereas I go to the balance sheet and I see interest payable last year is 100. So, what happens? How much is the total interest payable? I add payable at the beginning of the year 100. So, what is the total interest payable? The total interest payable, total interest payable is $500. But I see that I am yet to pay $230. Yet to pay $230. So, that I will reduce yet to pay at the end of the year is $230 out there. So, what is the amount that I have basically paid out there? The total amount that I have basically paid is, that is the amount, the cash outflow due to interest payment. The actual cash outflow due to interest payment in this particular case is 270 out there, and that is what I will take from here. That is what I will take from here in this particular case out there. Next, what happens? After interest payment out there, let us look at what is called as the what is called as the other part of it out here. In this particular case, interest payment is done. Then let us see, let us look at what do you call it as the other liability, anything to do with the investor, anything to do with financing. Financing is only share capital and debt out there. Last year the debt was 1040. Current year debt is 1110. That means what? Cash inflow has occurred, net cash inflow has occurred. I will do it out here. The current year debt is 1110. Last year is 1040. That means $70 of debt I have taken more. There is a net cash inflow of on debt of $70. Let us check and verify out. In this particular case, if you see this, an amount of 250 was raised from issue of capital, that's okay. Further $250 was raised through long term borrowing, was 450. Sir, you say 70, but it says 250. Yes, that is new debt borrowed. New debt in the company is $250. Yes. So, new debt borrowed $250. If the new debt borrowed was $250, then what should have been your debt balance at the end of the current year? End of the current year, the debt balance should have been 1040 plus 250. That means it should have been 1290 should have been the debt balance out there. But what is the debt balance you have? The debt balance what I have is 1110 in this particular case out there. So, that means this amount that I should repay. Let me do this with the help of a working out here. Let us say new debt borrowed, let me put it as ideal number 5 out there. In this particular case, let us get to the debt part of it. That is debt at the beginning of the year here is 1040. That is add new borrowing. How much is the new borrowing? 250. So, ideal debt balance, that means debt balance ideal debt balance should be 1290. But debt balance at the end of the year is how much? Is 1110. It is 1110. It is 1110. That means what has happened? 1290 should have been there, but only 1110 is there. That means this is the amount of debt you should have repaid. That is, or I would say old debt repaid is what is called as 180. So, what happened? New debt borrowed 250, agreed. Old debt repaid. In this particular case out there, when you repay, there is a cash outflow that has happened, the debt repaid is 180. 250 minus 180 is $70, what we basically see out there. In this particular case, you can see that 250 minus what do you call it as 180 is $70 what we see. You can verify this. What is the opening balance? Opening balance is 1110. What is the closing balance? Closing balance is this thing. So, what has happened? It has increased only by $70. That is the net increase that what I talked to you about. Now, let us go back and see the equity capital was 1250 last year, it has become 1500, and it says an amount of 250 was raised by issue of share capital. That means what? Cash inflow, issue of share capital is how much? $250 out there. Issue of share capital is about $250 out there in this particular case out there. So, what is the total cash flow from financing out there? Cash flow from financing. Oh, sorry, I missed out dividends paid out there. I missed out dividends paid. There is something out there in this particular case out there, what we call it as dividends paid. Dividend income is fine. There is something called as dividends paid out there in this particular case. There is a note here. The dividends paid in the year is 1200 out there. When dividends are paid, what happens? Cash outflow. Dividends paid 1200 out there. So, what is the cash flow from financing? What is the cash flow from financing? Cash flow from financing would be this 270 what is there from interest payment plus there is a new debt plus old debt plus issue of share capital plus what is called as a dividends paid out there. So, what happens? This basically becomes 610 out there.
I think cash outflow due to interest payment is negative 270. First item.
Oh yeah, this is dividends paid is $400. Am I okay with everything? Let's see. Oh, dividend cash outflow due to interest payment, that is should be negative. There should not be a positive sign, there should be a negative sign there. I missed that. Yeah. So, what is the cash flow from financing? Cash flow from financing will be cash outflow because of interest plus net new debt borrowed plus old debt repaid plus issue of share capital plus dividends out there. That should give me what do you call it as the cash flow from financing activity so much. So, what is the net cash flow I have? The net cash flow for the company. Net cash flow from the company is cash flow from operations plus cash flow from investing plus cash flow from financing activity. That is the net cash flow is $710 out there. What is the cash at the beginning of the year? Cash at the beginning of the year. This I will basically add the cash at the beginning of the year, add the cash at the beginning of the year. When I say cash at the beginning, I say cash and cash equivalents. Cash and cash equivalents at the beginning of the year out there. Now, sir, what do you mean by this cash and cash equivalents? Normally, when we say cash out there in this particular case, normally when we say cash, we will normally say cash and what do you call it? Normally when we say cash out there, we will say cash and cash equivalents. That means anything which can be converted to cash in a jiffy, anything which is equivalent to cash, which can be converted to cash very fast. For example, in this particular case, if you look at, there is something called as what do you call it as marketable securities. These are considered as cash equivalents because marketable securities can be converted to cash very fast, and this is considered as equivalent to cash out there. So, when I say cash and cash equivalent, I mean to say that $25 of cash plus $135 of cash equivalent out there is the total out here. So, if I add this to the net cash outflow, that means I should get cash at the cash and cash equivalents at the end of the year. At the end of the year out there. So, cash and cash equivalents at the end of the year out there in this particular case. So, let me see that cash and cash equivalents. I just have to put wrap text out here. That is the reason I borrow this. I funded this out there. So, that is 870 out here. So, is it 870? Let us see. What is the cash and cash equivalent? What is the cash? $200. What is the cash equivalent? $670 at the end of the year. What is it? 870. What is the figure we have got? $870. So, what happens? Cash flow is complete. This is what we call it as a direct method of doing cash flow. Let us try and see if we can do the indirect method also in this particular case. Let me close it. Let me see if I can do the indirect method also in this particular case out there. Okay, we will do the indirect method.